Okay, let's start. Hi again, everybody. Welcome to those who just joined us tonight. Today's webinar by StashAway will be talking as part of our wealth building series. It's titled How ETFs Provide Stability in Choppy Markets. So I'll be your speaker tonight, and my name is Albert. I'm the Deputy Country Manager here in StashAway, Malaysia. And you may have seen me around, been talking or conducting webinars with our Chief Investment Officer, Stephanie. Been with StashAway since we started here in Malaysia, and been happy to, I guess, help all of you here grow and invest your money over the long term. So before we start, a little bit of a disclaimer here that today's session itself, it's purely for educational purposes, and so it's really not about giving you any specific advice on what to do, but here's really all about it's about an educational session. And I mentioned earlier that this webinar is part of our wealth building series. So this is the third one, in fact. The first two that we did previously were talking about, firstly, on the psychology of investing. The second one was more about how the basics around investing itself. And just to recap on that one, those growth strategies which I talked about last week. When it comes to investing here, at least at StashAway, we're focused on long-term investments, really using the power of compounding to help us magnify our initial investments to get it larger and larger over time. And whilst we're trying to do this, we're also trying to overcome inflation. So inflation is that the value of things that you buy going up every year. It can be 2-3% or even 10%, depending on your lifestyle. So as we invest too, we also do not want to be overly concentrated into one particular area. So if I understand that us Malaysians here are comfortable or know about investing in Malaysia, but we shouldn't put all our eggs in one basket. There's also a need to diversify overseas, and that's where we want to avoid home biasness. So ultimately, what we're trying to achieve here is really to have like a portfolio that's diversified, and it gives you exposure globally. So not only in Malaysia, but all around the world, but also exposure to different asset classes out there. So asset classes will be things like your equities, bonds, and you can segment each of them to even smaller segments. Say for within equities itself, it can be a certain country or a certain sector. So that's what we kind of really went through in the last session. Today's session itself, before I really kind of dive into the meat of all of these things, I just want to do a quick poll, similar to like how I did it the last time, just to really understand where everyone is today, and also, I guess, make this session tonight a little bit more interactive. Okay, so if you're watching from your screen, just take out your phone, snap the QR code, and you see the Slido. You'll be directed to Slido itself, or if you're on your phone, you can just go to Slido and key in 1335706. So I'm going to switch to my screen now to show you the poll that I'm doing on Slido, and you can also watch in real time what the results are lah. Okay, so I'm going to switch. Okay, great. Hope you all can see the results of the poll. Once again, you can use your phone to scan the QR code, or just join us at Slido using the number 1335706. Okay, so the first question that I wanted to really get a sense of where everyone is investing today is where's your money, right? You have it in equities or unit trust funds, bonds, so on and so forth. So right now it seems like we have a few of you here responding to this, and majority of you seems to be investing into equities itself. Some unit trust funds out there, some in property, some in cash, some in bonds, and a smaller proportion within cryptocurrency itself. Okay, good to know. All right. So the leading candidate here seems to be equities. We've seen quite a few of you holding money in cash. Remember again, as I talked about last week, don't just put cash in the bank account. Yes, it's great in the safety and certainty of a fixed deposit, but there's always this thing called inflation that can potentially erode it away. So that's where it's important to look at other alternatives to invest, for example, into equities or bonds. All right, going to move on to the next question. Do you Oh, sorry, there's a typo there. Do you invest locally or overseas? This goes back to the question about, home biasness. Do you just invest all in Malaysia, or do you have a little bit of diversification overseas too, or do you only invest overseas? Hmm. Okay. So it seems like quite a bit of you here are investing overseas and also in Malaysia. So that's great. Great to know. Good, good, good that you're practicing that diversification benefit I told you all about. And the next part, which is what is your investment style? It's a bit of typo there again. Yeah, do you go for short-term trading? Do you go for the long-term buy and hold, or do you have a mix of them? Okay. So some of kind of a split between those who kind of hodl for the long term and those who do long term and short term too. Pretty balanced at 50-50. Okay, good to know, good to know. All right. Now, finally, how are you all feeling about markets currently on a scale of one being fearful to five being great? So you may have heard recent news. We have a lot of news coming out of China itself. We have, a bit of a crisis happening in the Middle East itself with rockets being shot up at the sky. So, for those who are investing right now, you feeling good? Feeling not good? Feeling a bit scared? All right. Generally, most of you are a fair bit more of you are a little bit more on towards the optimistic side at four, and one third of you are leaning towards the fearful side. Okay, good to know. Good to know. All right. Finally, do you also know what ETFs are? We're going to be talking about that today. Yes, you know what ETFs are? Great, great, great. Okay, that will make my job a lot more easier today. Do you invest or have you invested in ETFs? Yes, no? Okay. So all of you, well, quite a few of you here know what ETFs are, but not all of you have invested in ETFs. That's my takeaway from today. All right. And okay, still around 70-30. Okay. And a very interesting question to round it all off. Would you invest in a Bitcoin or Ethereum ETF today? So for those of you who didn't know, or I hope, or some of you may not know what is Bitcoin or Ethereum. It's a cryptocurrency, and the ETFs for these two were launched Bitcoin early in the year and Ethereum a little bit later. So almost half seems to be saying no, one third seems to be saying yes, and about 17% of you don't know what it is. Okay, seems like a strong no from a lot of you here. You wouldn't invest in it. Okay, good, good, good. All right, so that kind of ends the poll itself. I think I've gotten a decent sense of where everyone's investment appetite is, and also whether you're keen to invest into Bitcoin or Ethereum ETFs. Fun little fact there. I'm going to switch back to my slides right now. Okay, great, great, great. Okay, we're back. So as I talk through the different topics today itself. If you have questions based on what I'm talking about, please feel free to post them in the Q&A chat box and I'll attend to them afterwards, all right? Okay. And so without further ado, let's talk about markets first. So the last few weeks, if you have been an investor in the market, has can be certainly a bit nerve-wracking. There's been a lot of news events that has been driving the performance of markets. What I'm looking at here is the FTSE All-World Index. So this is a representation of the global equity indices. And as you can see, the past few weeks, spanning from say June, July to September, it's been of a up and down scenario. So when I say nerve-wracking is, one, for example, a few weeks of down 5%, the next few weeks is up 6%, down 4%, and up 4% again. So it's been a bit of if you're kind of the investor who's trying to trade it, timing can be a little bit tricky here. But if you look at this and you zoom out a little bit to look at things from a big picture perspective, right? So this chart that you see here is actually a small little blip in the longer time frame. So the time frame that I'm picking here is a period from 2014 all the way till 2024. So essentially the last 10 years. Zooming out, things don't look so bad. Yes, there's some volatility in between, especially you see the big drop that happened in March 2020 during COVID itself. Trend-wise is generally up, but there's a bunch of ups and downs that happens along the way. That's the nature of investing here. And the reality of it is that when it comes to investing, it's not going to be straight line all the way up. There will be ups and downs, as I mentioned earlier. As you can see, I've highlighted certain periods where red is represented by kind of like a downtrend, green is represented by an uptrend. So that's kind of part and parcel of investing. And when you're investing your own money itself, that you might be comparing, oh, here's better, there's better. I'm taking the example of the S&P 500 here because it's one of the key indices that a lot of people do reference when it comes to investing and say, wow, look at the US market. US market, usually S&P 500 is the proxy for US market. They say, wow, it's done all-time highs. Yes, that's correct, all-time highs. But this period that I'm showing you here, the chart that goes from September 2022 to September 2024, it's trending upwards from roughly 3,500 to about 5,500. It's not the most updated, it's up till the start of September. But the point that I want to make here is that even though it's trending upwards, along the way, you will see quite a bit of drawdowns that happen. How do I define these drawdowns? These drawdowns are a drawdown from the last high to the current price. And the drawdowns that you do experience along this way, right, where the index has the S&P 500 here has really gone up over this duration, has also seen a lot of drawdowns of 4 up to even 10% drawdowns. So volatility or a price movement downwards in particular here is part of investing. And so when it comes to investing itself, as a result of that, it can be pretty timely if you were trying to, well, it can be pretty costly if you're trying to time your entry and exits of it. So the numerical example that I'm trying to show you here is that if you had invested 10,000 in for 20 years into the S&P 500 from January 2003 all the way to 31st December 2022, which is a period of 20 years, then you would have made a pretty decent sum of money. But if you miss the 10 best days within this 20-year period itself, your returns would have halved or more than halved if you compare to a situation where you invested throughout the entire duration. Right? Missing the next 20 best days will see your returns drop even more. Missing the 40 best days within a 20-year period, within the 20-year period, will see your returns 87% lower. So it can be pretty costly. I'm not telling you not to do it, but if you get it wrong, it can be pretty costly here. So when it comes to investing, like we talked about in the very first webinar, which we did, is that it can be emotionally intense. you have one point where, yes, markets are going up. That's great, right? You feel that excitement, something that you want to share with your friends, that you're making a lot of money. But then if you do if your market starts to suddenly turn, then you feel the anxiety, then you feel, maybe I should do something about this. You're feeling a bit fearful, and then you're thinking, maybe I should just continue to hold on a little bit more. That's where really the emotions come into play. You think, okay, as markets fall even more, you're going to hold on until the point where you actually capitulate, and then you decided to sell. But then as things start picking up again, then there's a bit of hope, and then you finally decide to come back in again. That's kind of a very a generic description of how emotions can really play into investing as markets go up and down. As I mentioned earlier, it's not a straight line up. There will be periods of up and down. So how can we, overcome the emotions here? One way to do it is through dollar cost averaging. So you might have heard about me talk about dollar cost averaging from time to time, but what it is essentially involves you investing a fixed amount of money. It can be on a weekly basis, it can be on a monthly basis, quarterly, or any other intervals that you decide to choose. Here, the aim of dollar cost averaging is to prevent you from, over investing at the wrong point in time. Is I going back to the slide that I showed here, right? If you time it wrongly, you miss out the 10, 20, 30, 40 best days. It can have a big impact on your return, especially if you're investing over the long term. And today we're talking about long-term investing, not about short-term investing. So I do understand earlier from the poll that there's a mix of you that also do some short-term trading, but here we're really focused on that long-term aspect of it. So what the key thing here with dollar cost averaging is that time in the market is more important than trying to time the market, right? Again, bringing back to the point of missing the next 10, 20, 30, 40 best days in a period of long-term investing can have a big impact on your overall returns. So here is actually a numerical example of how dollar cost averaging works. If you're just curious to know, why don't I just put in my whole lump sum money rather than spreading it out over a period of time? This time here that I'm chosen is 6 months. So imagine a scenario where you have $6,000 and you have an option to invest into a share, either lump sum or you dollar cost average every 6 months. So in the first scenario where you are able to do it lump sum, so and the price of a share is $2, let's say. So 6,000 divided by $2, with that you have 3,000 shares. In the other scenario where you could dollar cost average $1,000 every 6 months, so within the first month one itself, your 1,000 will buy you 500 shares at $2 a share. Okay. And let's just say, hypothetically, that the price of this share will fluctuate up and down. Again, like I said earlier, markets will go up and down. Say it goes from $2 to the next month, 225, you dollar cost average $1,000 in there. Month three, you dollar cost average at $1.25 there, 105 the next month, 110 the following month, and then finally 250 the last month. So the little balls there show you how much the share price is worth at each point of your dollar cost averaging month. And then here are the additional number of shares that you are able to buy. Obviously, as the share prices go down, you're able to buy more shares with it, right? And as the share price goes up, you do end up buying less shares with it. But the idea is for you to invest at a periodical basis, and with that, in this example here, I show you that you're able to get 4,005 shares through a dollar cost averaging approach versus a lump sum approach where you just got 3,000 shares. So essentially, you got your same amount of money has bought you more amount of shares by just dollar cost averaging versus lump sum. Obviously, we don't know whether the market is going to be, going straight up or potentially down in a period of time. So this is how you can employ dollar cost averaging as a tactic within your investment portfolio itself to make sure that you don't end up missing those the 10 best days or the 5 best days within your investment period. Okay. Hope you all learned picked up a little bit from this numerical example here. So now that you want to invest, what then should you invest in? I know I brought this slide up last week, but or 2 weeks ago, but I want to just kind of re-emphasize the point again. Right, if you do you invest in a single stock, and the example that I'm using here is Boeing. Right, Boeing hasn't really done very well. In the last 5 years, we've seen is share price fall pretty drastically. Naturally, with during COVID, with everyone else too, but it hasn't really moved anywhere and been kind of lackluster the past few years. Yes, it's been affected by multiple events, COVID being one that applies to everybody here, but also there are a few specific events that have impacted the company as a whole. So, you see like deliveries being halted, them having a door blown out of their plane mid-flight, and more recently there's been strikes and also I think layoffs that was just announced recently. So, not being so great for Boeing itself, right? So rather than investing in Boeing itself, if say you were very optimistic about the economy reopening post COVID, right? People are traveling more. The alternative could have been to invest into an ETF here. I'll talk about what ETFs are later, but this ETF, which is represented by the XTN ticker, is represents the transportation sector as a whole. So rather than just purely an airline itself called Boeing, you have through this ETF here exposure to a whole bunch of companies operating within the transportation sector. And as you can see, it did fall during COVID, but it did also recover pretty nicely post COVID and throughout the subsequent years. So it's been up about 28% within this 5 year time period compared to if you had invested into Boeing itself. So what it is this is kind of the power of diversification. Really, again, emphasizing the point that I mentioned 2 weeks ago in the webinar. Diversification here through a group of similar companies really help you manage the downside. As you can see during COVID, it did not fall as much as how Boeing fell, and it did kind of recover pretty nicely after that too. And also, diversification helps you sleep because you don't want to be worrying too much about investing into something that might be too risky for you, and you're always thinking about it, and you're unable to sleep soundly at night. So this is how diversification can certainly help when it comes to building and constructing your own portfolio. And you might think, this could be something that is limited, or maybe I'm cherry picking within a certain sector itself. But say within the tech sector, right? That's also another sector that's been very, very hot in the past few weeks or even years. We've seen Tesla, which is one of the very interesting, or you can say controversial stocks out there with Elon Musk at the back of it all. Yes, it was a darling, especially during the COVID period. But then subsequently, there were also issues that have affected, that were specific to the company itself that affected the share price. So as you can see, the value of Tesla, yes, at one point it did appreciate up to 180% if you invested in January 2021, but also it has been pretty volatile up and down throughout the entire period. Compare that with the XLK ETF, which is an ETF that gives you exposure to the whole tech sector as a whole. That allows you to navigate through the or mitigate a bit of the volatility that you've seen on the Tesla side. So rather than just purely into investing into Tesla, diversification through this ETF XLK here, this really help you invest over the long term and navigate through the periods of that kind of volatility. So here is another example of how diversification can help you within the tech sector itself. I'm going to use a quote here from the legendary investor called Warren Buffett. The trick here is not to pick the right company, but the trick here is essentially buy all the big companies through the S&P 500 and to do it consistently. So the concept is similar to what you see here in the form of using an ETF called XLK, or the ticker is XLK, to get exposure to the tech sector. All right. So how then can you invest in a basket of asset classes effectively, right? So imagine you want to have a portfolio, an investment portfolio for yourself. It might consist of certain investments into property, certain investments into equities or bonds out there, or even commodities, right? How do you then go about filling up your investment portfolio with exposure to different asset classes out there? This is where ETFs comes in. So as I alluded to it a few slides ago, ETFs, it stands for exchange traded funds. So what it is it's a fund that's listed on an exchange, and the aim is to track a particular asset class, be it an index, be it a basket of, say equities, bonds, or commodities. So that's what ETFs are in plain simple language. Through ETFs, they can come in different sizes and forms. So you can have an ETF that tracks a particular index, for example, the S&P 500. You can have an ETF that gives you exposure to a particular sector. Earlier, I told you about the tech sector, the transportation sector, or even healthcare sector. You can invest into an ETF that gives you exposure to commodities. So, what commodities like gold, which has appreciated quite a bit this year, oil more recently because of the war in the Middle East, other commodities, agriculture side like corn, for example, or even cryptocurrency. I did ask a few of you earlier about your keenness to invest into a Bitcoin or ATM ETF. And then you can also use ETFs to invest into or get exposure to a particular country, right? So rather than buying a whole basket of companies within a country itself, you can just buy one ETF that gives you exposure to one country, Japan, China, which is pretty in the news recently. Or you can also use an ETF to get exposure to a particular investment style. So say if you want to just purely buy large cap companies, so companies above a certain size, you can use ETFs too to do it very simply. You can use ETFs to buy growth focused companies, right? So companies that focus on growing, compared to value companies, which is essentially buying companies at a bargain, right? So they do come in different flavors out there. It's really up to you how you want or what you want, what flavors you want to have in your portfolio itself. And why use ETFs, right? So as I have shown in the previous example, you want ETFs for diversification purposes. You do not want to overexpose yourself to any particular companies unless maybe you feel that you have a very strong knowledge of the ins and outs of a company, what moves the share price, what events are happening, what catalysts could be coming up that could be great for it. But assuming you are not 24/7 following the company itself or a particular area, then ETFs can certainly help you with that diversification angle. Cost efficiency is in the previous example here I mentioned about buying an ETF that gives you exposure to a country rather than buying all the companies that are operating within a country itself. Imagine how many countries there are in Malaysia, right? You can just buy one ETF that gives you exposure to Malaysia. Apply the same concept to other countries all over the world. So it's very cost efficient because you don't need to keep repeating a buy transaction X amount of times to give you exposure to one whole country. And again, the last point on ETFs, they are listed on an exchange. So it allows you to go in and out very easily, right? So you can buy, you can sell when the market opens. That's part of the beauty of it all, right? That liquidity. You do not want to find yourself in a situation where you want to sell your ETF, but then there's no buyer on the other side. And so that with ETFs, it allows you access to the exchange where there's a lot of liquidity and you can use it to get exposure to any areas that you want. So you might then ask me, okay, Albert, how are ETFs then different from unit trust funds, which is something pretty common in Malaysia? And so ETFs in general, they are passively managed. So, the aim is to really track an index or track a particular asset class. They're traded on an exchange too. Compare that to a unit trust. They are actively managed. So the aim is to buy and sell to different degrees of activeness with the aim of trying to beat a certain benchmark or the market. They are not traded on an exchange. So with unit trust, if you want to subscribe or you want to deposit money, you would be buying or selling your units itself in the fund provider based on a value that they will quote to you at the end of every day. So they say, okay, if you want to you have 100 ringgit to invest into this unit trust fund, Well, typically the minimum entry for unit trust fund is about 1,000 ringgit. If you have 1,000 ringgit to invest in the unit trust fund, then they'll quote you a price at the end of the day, and then based off that price at the end of the day, you'll say, okay, your 1,000 ringgit will allow you to buy X amount of units. Compare that with ETFs itself, because they are traded on an exchange. There's always you can buy and sell at any point in time, so you're not locked in to say the end of day pricing, for example. So it'll be priced based on the factors in the markets of supply and demand. So as long as the market is open, you're able to buy and sell ETFs. Typically, ETFs they do carry lower transaction costs because they are a bit more passively managed. They're not meant to be too active itself compared to unit trust funds, which does have a bit more of an active component. When I say active here, meaning there's a fund manager in there to make decisions to buy and sell with the aim of beating a market. So that with unit trust funds, it can carry a higher transaction cost. And so there are ETFs have been around for a pretty long time. I think maybe going back to the past 30 years or so. And so there are more than 9,000 ETFs worldwide. How do you then go about picking them, right? So there can be multiple ETFs doing the same thing, meaning tracking the same index, tracking the same, country, for example. So we really want to firstly, keep it simple, because there can be pretty funky ideas that you can do with ETFs out there, but in terms of simplicity, we just want ETFs to allow us to track exposure to a particular asset class. We want to do it cost efficiently because some ETF providers, so the guys behind the scenes that enable ETFs itself, we call them the fund providers, they might produce or issue an ETF out there that at different costs. So when you look at ETFs, check what the costs are associated with them. These costs are typically termed as expense ratios. You want to also make sure that ETFs are liquid, so there's enough trading volume, the size is large enough so that you don't suffer as a result of a bad or low pricing that you're given when you are either buying or selling. And finally, on the a low tracking error itself, what does a low tracking error mean? Is that there could be multiple ETFs tracking the same index, but one tracks the other one better. So let's just say if gold, which you're tracking, goes up by 10%, ideally in a perfect world, your ETF that tracks gold would also go up by 10%. But some might not be so efficient, maybe just purely because from an operational issue standpoint, it might only go up by 9%. So obviously you want to go for the ETF that has a low tracking error that would go up by 10%. That's the dream scenario here. Obviously, things may not be perfect, so you're trying to get to as close as best to the in terms of the performance tracking the underlying asset class there. So right now, if what I'm talking about here with regards to ETFs are too overwhelming, that's where I guess StashAway's general investing portfolio, which I talked about previously, can really help you. And how we look at portfolio construction, or how we look at ETFs in a portfolio itself, is something like this. You have a portfolio that gives you exposure to a whole bunch of equities, bonds, and commodity like gold out there, right? You have within equities exposure to country, US, global, and within bonds, you can have bonds issued by governments, bonds issued by companies, or just any other type of bond out there. And within each asset class here that you see on the screen here, they can be represented by an ETF. So, these US equities, for example, you can have IVV, which is the ticker that represents the S&P 500. You can have XLV, which is the ticker that represents the healthcare sector, or XLE is the ticker that represents the energy sector. So each sub point that you see here on the right-hand side is an ETF that represents a particular sector, and that sector or country would fall under that umbrella of US equities, global equities, so on and so forth. So what we do at StashAway is we aim to build a global portfolio that is diversified. So it gives you exposure across the different asset classes. This is just one example that I'm showing you here. We have multiple portfolios, and it's built to be cost effective. So cost effective meaning, through the ETFs itself, we can reduce costs as little as possible. So With less cost, that means more returns to you over time. And how then do we employ the investment framework when it comes to investing in the portfolio that you see here, right? This portfolio may look like what it is to now today, but it might change in the future. So we have in StashAway this investment framework called ERA, ERAA. It stands for Economic Regime Based Asset Allocation. And it essentially is able to kind of slice and dice the global situation now into four different quadrants. So you can see there good times, which is represented by a positive growth times and low inflation. Inflationary growth, which is where we are right now, is where you have positive growth, high inflation. A recession is typically dictated by negative growth and low inflation period. And then you have stagflation on the bottom right quadrant, which is where you have negative growth and high inflation. So the idea is for this investment framework itself, we try to pinpoint where are we within the these of the each of these four quadrants here. Are we right now in good times or inflationary growth, recession, or stagflation? And then once you know where in these four quadrants are, then what should the asset allocation be? So that's the second part of ERA that comes in, right? How we do that is by looking at different times in the past. So for example, in a recession, in a example where there's only two things that you can invest. So you have the S&P 500, which is like the US index, then you have US government long-term US government bonds. So looking back from a period of early 2000s to about 2024, you see that on average in a recession, for example, S&P 500 it doesn't do very well. On average is down about 5.5% compared to US government bonds, which tend to do about 4%. Moving on to good times is when you have S&P 500 outperforming US government bonds. Similarly, for an inflationary growth environment, and the reverse, where long-term US government bonds do better than the S&P 500 in a stagflation scenario. So this is just a very simplistic view of a world where you only have two asset classes that you can invest into. But once you know which quadrant you're in, whether recession, good times, inflationary growth, or stagflation, then you can say, okay, if you're in good times, for example, then yes, we should have more S&P 500. We shouldn't have any US government bonds. In the flip side, if we do enter a recession, we want to have more US government bonds. So that's how, by understanding the performance of different asset classes over a historical period, we can say what asset classes should we then have in our portfolio given a certain economic environment. And so with ERA itself, we then, once we know, okay, this is a particular asset class that we want, then what ETFs can we use to get exposure to the whole bunch of asset classes that you see on the screen here? So these are different kinds of asset classes that us at StashAway, we can potentially consider within our investment universe. We may not decide to put all of them into a portfolio itself, but we'll see, okay, maybe US equities is good now, good for this period now, so we want to have that. Then what kind of ETFs can we then use to construct the portfolio that you see here? So I did briefly mention previously, we at StashAway use this thing called a StashAway risk index to describe the risk of a portfolio. And if I were to generalize it goes from conservative all the way up to aggressive. We use a numerical figure to describe the risk of that portfolio. So for example, the 36% risk portfolio, which is the most aggressive, it means there's a 1% chance of losing more than 36% in a year. It's our way of doing it so that it's easy for you to quantify it, rather than just say, very vaguely, this is an aggressive portfolio, because, aggressive to you could be something different from my definition of aggressive. And then so with each of these different risk portfolios, given that we know what economic environment we know that we want a particular asset class to have in our portfolio itself, then we can put those ETFs inside to construct a portfolio that's suitable for you. And then as you can see at the very bottom there, those are the returns that each of those portfolios, all the way from the most conservative to the most aggressive portfolio, how much have they delivered from in 2023 itself.
Okay, so the I like to use an analogy to describe how StashAway uses ERA to determine what should be in your portfolio itself. So I mentioned earlier we have the four different quadrants. We have good times, inflationary growth, a recessionary period, stagflation, and each are characterized by a y-axis growth and x-axis inflation. Imagine you have the four seasons, right? So for example, when growth is great, inflation is low, it's kind of like, oh, maybe you should be wearing this particular outfit in when it comes to winter itself. It's us recommending to you you should be wearing a winter jacket, for example. When it's summer, then you should be wearing your beach wear. So that's the analogy that I like to use here when it comes to how StashAway um, as uses an investment framework to recommend what should you have for each of the four seasons that you see on the screen here, right? So with this, there we might change sometimes when it goes from one period to another. So right now we're in inflationary growth environment. Previously, back in December 2022, we looked at the different data. That's part of the research that we do and we determined that the global economy was in a stagflationary period. And then subsequently, this year itself, in April, we looked at it and say, oh, the economic conditions are pointing towards an inflationary environment. So we will then make changes to the portfolio, which I'll show you an example of it later, of us going from a stagflationary period to an inflationary growth environment. And this change is what we as StashAway call a re-optimization. So some of you who are StashAway customers may have heard about this from us before. Essentially, what it is a change in the composition of your portfolio to reflect the current economic conditions. So going from a stagflationary environment to an inflationary environment. You might ask me then, okay, Albert, what's has this really delivered any benefits? Because we have been around for some time and we have done multiple reoptimizations over the past few periods. And as you can see at the bottom right corner there, when we switched our portfolios to a stagflationary environment back in December 2022, if we didn't change that at all, then we would have underperformed by 2.4%. So essentially, because of the change, up to the returns were better by up to 2.4%. And because of the recent change in April itself, 2024, this year, our portfolios have performed better by up to 3.3% up until the August period itself. So that's the value proposition that StashAway is trying to bring to all of you here, in the sense that we are managing the portfolio for you. We are making sure that it's able to navigate through different economic conditions through re-optimizing it. So you don't have to do anything behind the scenes. So we handle it. And anytime such a change like this does happen, we will always inform you, oh, okay, we're going from, say, stagflationary to an inflationary environment because of XYZ factors. It's part of the transparency that we have here at StashAway. And so what specifically does it mean then to be in an inflationary growth environment, which we are in right now? So in an inflation growth environment, just to give you a specific a deep dive into the asset classes itself, you see that US industrial equities, the S&P 500 and global equities, they outperform cash. So if just rather than holding cash in such inflationary times, because which is very logical, right? If you have holding cash in the bank account, the value of it just gets eroded by inflation over time, and hence you should be investing it somewhere, right? Whether it's into the equities of the S&P 500 or somewhere globally, okay? And in such an inflationary period of time, your long duration US treasuries, they don't tend to do that well, purely because they pay coupons. So coupons is like an interest on the bond itself, and the value of that fixed coupon, fixed interest, is eroded by inflation. Hence, it's not so attractive compared to, say, the other equities. And this is how we kind of put it to work, right? In an inflationary growth environment, the old portfolio, which was geared more towards a stagflationary environment, I'm choosing a particular portfolio here, which is the 22% risk index, had about 46% exposure to equities, 42% into bonds, and a pretty big exposure of 11% to cash. After the reoptimization, what happens? It the equities component goes up from 46 to 55%. So there's a larger shift of the portfolio into equities. Where is that coming from? It's coming from cash. To a certain degree, also, we have some increase in the allocation of bonds, but generally these bonds are towards, not the is towards the government bonds, which are deemed a little bit safer compared to, say, the corporate bonds itself. So that's an kind of a visual example as to how we change portfolio from old to new, given a change in the economic conditions. Meaning, right now today we're in an inflationary environment, and so how just this slide here then kind of summarizes your journey when it comes to investing in a general investing portfolio with StashAway. The process or the journey is really about, firstly, choose a portfolio that is in line with your risks, and you're done. You don't need to do anything else. StashAway then kind of takes the lead on it. What I mean by that is, we will, given the particular risk level that you choose, we will then decide, okay, how can the portfolio be best optimized for the current economic conditions? Once that's done, if there's any changes along the years of you investing into StashAway in economic conditions, we might make periodic changes. So that's what we call the reoptimization. And with us along the way too, on a monthly basis, you might get articles from our chief investment officer. On a weekly basis, we'll update you on things happening right now, what's driving the markets, and we also do webinars and in-person events. So that's that's kind of the additional bits in terms of updates that you get in addition to getting your own investment portfolio with StashAway. So kind of the key takeaways here is that when it comes to investing itself, and I'm going to be talking a little bit more about markets, is that it's full of risks. I want to emphasize that when it comes to investing, there is no, risk-free investments. Well, if you can consider fixed deposit, you may consider fixed deposit as a risk-free investment. But when it comes to long-term investing, here is there's a lot of risk in there. Yes, we have in a few weeks' time, in fact, a U.S. elections that can determine the fate of the world to a certain extent. You have talks about recession especially in early in the year, and it has kind of died down for a while. You have geopolitics happening. You have AI too, which is one of the key buzzwords, key investment themes that's been playing out over the last few months to over the last few years. So when it comes to investing, there's a few of these things here. More recently, also, you have China coming out with their big monetary stimulus and potentially some fiscal stimulus, putting money into the hands of the people to prop up an ailing economy, because they are affected by the clampdown in different sectors within the property sector itself. China trying to deleverage. On the other hand, also the last 2 days, we have had a bit of unrest within the Middle East, and you've seen Iran firing a few rockets over to the other side, and that's causing a bit of tension in the global political scene. So all these different things that you see on the screen here, they have an impact when it comes to investing, especially if you're investing globally for the long term. So it's part and parcel of investing. This whole journey. Emotions are part and parcel of it. It'll be up and down. It's never going to be a straight line up. So how then can you overcome it, right? So goes back to the point I made earlier about dollar cost averaging. Time in the market is more important than trying to time the market. You can use ETFs here to help you diversify your exposure, so you're not overly exposed to one particular sector or one particular, say, maybe country, for example. If if things don't go bad, things do go bad. And it's also important to stay nimble throughout different economic environments here, so your portfolio doesn't stay the same forever, right? Because it needs to be able to adapt to current times. Whether are we going to a recession, or are we coming out of recession, going into a pickup in the global economy, right? So that's where something like a general investing portfolio by StashAway is able to help you here. And so with that, just want to end it off with a little promo. Some of you who have attended the webinar 2 weeks ago might have seen this again. This is the same promo, which allows you to have free investing for 3 months. And if you invest into a general investing portfolio by StashAway for the first 30K, you don't have to pay any fees. So I'm just going to leave that code up there. If you have any questions based on what I just talked about, how you can use ETFs, how can you employ the concept of diversification when it comes to investing and building your own portfolio, um, feel free to post them in the Q&A box. I will address it now. And yeah, let me just pull up the Q&A chat box to see. Okay, we have a question here. How can you use ERA effectively when different regions typically go through different economic conditions? So, for example, you have the US, Japan, China all going through different economic regimes at the moment. Very good question. Um, there are, we do actually look uh, at economic conditions from a global perspective. So we do take into account what's happening in the different countries that you have mentioned earlier. But obviously, we do give a larger weight towards economies that are generally bigger because they tend to drive global growth. So we do kind of weight it when we look at different economic variables. So things like growth, things like inflation, for example, to come to a conclusion. All right, are we in an inflationary environment? Are we in a recessionary environment? Okay. Um, Hope that was enough to kind of address your question. The next question is, would like to ask about VOO ETF and MGK. And is China's stimulus temporary, or will we have a negative effect to the US market as Malaysia market is more or less similar with the US market? So I'm not too familiar with what MGK is, but maybe I'll address the question about the China stimulus. So in the past, for those who have been following in the past, I would say 1.5 to 2 weeks, we've seen a whole slew of measures coming out by the Chinese government to really inject confidence back into the overall investment uh, scheme. So we've seen a lowering in the home buying requirements from different cities itself. We've seen them coming out with more relaxed requirements for companies to buy back shares. We've seen also to a certain degree a mention of a stabilization fund for the government to go and buy ETFs, in fact, of China itself. So I think all these serves to really set a stage of confidence initially, but I think there needs to be more to address the underlying issues within China itself. This is a personal opinion that I have here. So within China, you see what is really slow right now is, or what's really suffering is consumer spending. And with that will take time to build back consumer confidence within China itself. And the recent measures is still too early to see whether they have an impact because they have more of an impact from a financial aspect, not so much from an actual consumption, which will involves people buying and selling goods. There has been talks of fiscal injection, meaning cash handout to people, but there's still been pretty limited information about that for China. Whether what's happening in China has an implication to other markets, whether say in Malaysia or US itself, I think there will be in terms of positive sentiment, right? China, we know, is one of the key big drivers in terms of global growth. They are one of the biggest exporters around. So whatever happens in China, if the different policies that the government has introduced there is able to firstly inject confidence, and that confidence translates to change for the better in the underlying trends of consumption and people spending more, which can improve things like their their economic growth, for example. Then yes, it does have a very good spillover effect to the other markets, whether it's in Malaysia or even in the US itself. Really depends on what sector. You have to kind of zoom in to there. Okay. Any other questions? I believe there were a few other questions that were asked also, but I have a few colleagues behind the scenes that was addressing, that may have addressed some of your questions already lah. Um, yeah, so on this next question, which is on MGK itself, I wouldn't know. Okay, it's an ETF that comprises of the US with almost 20% of the portfolio in the consumer discretionary sector. Um, I wouldn't be able to tell you why Futu Holdings is going up almost 50%. So, because I don't monitor Futu Holdings specifically, but what I can say is that when it comes to ETF itself, the idea is not being too focused on one particular company, but rather employing diversification to help you build that gain exposure to, in this case here, the US sector or growth stocks lah. So I think that's how I would look at it. I wouldn't be able to tell you company specific angles here. Any other questions? Okay, a few more here coming in. By Kylie, I was wondering if I can get your point on rebalancing. So I rebalancing my portfolio by dollar cost averaging on underweighted stocks or ETFs compared to overweighted shares. Is it better to rebalance like how StashAway does, where we buy and sell ETFs based on a percentage weight of the portfolio versus the targeted? So perhaps maybe I will take a step back to explain for the broader audience the difference between rebalancing and reoptimization. So reoptimization is a change in economic conditions that might necessitate a change in the composition of your portfolio. So the ingredients or the ETFs in your portfolio changes as a result. Whereas what Kylie is asking here is a rebalancing is where, let's just say if you have one portfolio that comprises of two ETFs in there, 50-50 weight, and say one ETF has appreciated in price such that the weight of one goes up to 70%, the weight of the other one goes down to 30%. Not to say that the value of the one that went down has gone down, but just that one has appreciated so much that it has taken a larger portion of your entire portfolio. So what StashAway does when it comes to rebalancing is that we have a target weight. So let's just say the target weight is 50-50. We bring it back down from 70-30 to 50-50. And um, the the rebalancing that we do here in StashAway is on the condition that it meets or the weight exceeds a certain threshold. There's no right or wrong as to what threshold you should use. So for us in StashAway, you use a threshold of 20%. So if the current weight exceeds the target weight of 20%, so in my example, the 20% of 50% is 10%. So if the weight of the ETF goes above 60%, then we will bring it back down, because you don't want to you don't want to rebalance too early, because you end up missing out on potential gains that can come from on an ETF or even a stock going up, right? You don't want to sell out too early, but you also do not want to overly expose yourself to something that has gone up a lot but might come down subsequently later. So that's where it's a fine balance that you personally for yourself you might want to figure out, would that number be 20%, or maybe you have a certain target where if it goes up X amount, then you rebalance it back again. But what we at StashAway is we use a 20% target weight. So if it goes beyond the value, the target value by 20%, then we will bring it back down. And we do this check every time, so you don't have to do this at all. Okay. Um, let's see got some questions streaming in right now. Are there further plans to bring in more Irish domicile ETFs? Yes, there's always plans to bring in more ETFs on the StashAway platform side. We look at a few criteria when it comes to putting up ETFs or on the platform. So it's looking at things like liquidity. Is it large enough from a size perspective? Is it cost effective? We don't want to end up buying an ETF that's too costly and that impacts returns over time. We want to make sure that it has low tracking error. So there's multiple considerations that we do go into we do take into account before deciding, okay, whether this ETF is right. But we also want to also introduce an ETF, not for the sake of introducing it, but to fill up an asset class that we currently do not have exposure to. So from time to time, we do make announcements that, okay, we have added these 3 new ETFs in there. For example, the most recent few ones, if I recall correctly, there's silver, there's a uranium ETF into the other, what we call the flexible portfolios. That's where you can pick and choose ETFs for your liking. Okay. Um, all right. So the next question is, if you're comparing ETF and unit trust funds where the portfolios are diversified but both also depreciate nowadays, I believe some fund managers are diversifying to gold. And do you mind to share any ETF that focuses on gold or metals that are quite good in terms of annual performance to overcome the choppy year due to volatility market? Yeah, we actually in StashAway we use gold. I think the most popular gold ETF out there, most popular and most effective, I feel, is the GLD. So look up the ticker called GLD ETF out there. It's listed in the US. It's physically backed. So there's actually a vault that stores GLD, stores gold. And then by buying the GLD ETF, that's how you get exposure to gold. So gold serves a very good role as an asset class that gives you protection against multiple things. Firstly, you have protection against geopolitics, protection against inflation, or it can do very well right now in an declining interest rate environment that we're seeing. So it does serve a few roles. I do understand the other side of the argument that says gold is also a like a non-yielding asset, right? You just buy gold, it doesn't do anything, it doesn't give you any interest, it just sits there. But it does serve as a way to also diversify your entire portfolio. If something unforeseen really does happen, say if we go into touch wood, we go into World War III, for example, right? Gold does have value there. Okay. Um, the other question is on UVIX ETF. I'm not sure what that is, but I wouldn't be able to tell you whether it's good for short-term or long-term growth. I think with all these uh, at least on the StashAway's approach when it comes to investing, is that we do take a long-term um, uh, view when it comes to deciding what should go in your portfolio itself. We don't try to time it short-term because, well, firstly, that's not in our philosophy. But as you have seen earlier through the example I shown, that if you do try to time the market and you get it wrong, then it can be pretty costly. Okay. So I'm not saying you shouldn't try to time the market, but if you don't have time or you don't spend your most part of your days tracking movements in the markets, then maybe it's better to kind of leave it diversified so you don't overly expose yourself to any particular risks of a company, for example. Okay. I don't see any more questions. But if you have any follow-up questions on what I've talked about today, or just in general on StashAway, you can reach out to us at support@stashaway.com. We are there to help you. If you have already downloaded the StashAway app, we are also reachable through the WhatsApp button that will appear when when you go into the StashAway app itself. So we're there to help you address any questions that might come up. But with that, I see I am past time already, so I don't want to hold any of you if you're planning to have dinner after this. I hope you all learned something today. And thank you again for attending tonight's session. Um, Take care, everyone, and thank you very much for joining us with this 3-part webinar series by StashAway. Take care, everyone. Bye bye.